You're listening to The Weekly Edge, your straight-talking guide from industry experts on what's really moving the fixed income markets, here in Australia and around the globe. Brought to you by Gilt Investments. The Weekly Edge is your go-to podcast for sharp, actionable insights into the forces driving bond markets. Each week, your hosts Alastair Healey and Richard Brennan take you on a fun and insightful romp through the financial markets. With their no-nonsense style and deep experience, they help you cut through the noise. Alastair's deep market smarts and Rich's trend-driven mindset make for the kind of conversation that keeps investors sharp, and always one step ahead. Quick hits, smart takes, real perspective. Let's dive in.
G'day everyone, and welcome back to the Weekly Edge. It's Thursday, June the 5th, and this week we've got a full-blown pressure cooker. Trade tensions between the US and China are erupting. Oil markets are sending mixed signals. Consumers, especially in the US, are nearing the breaking point. And central banks, well, they're caught between a rock and a recession. Inflation is just refusing to go away. Al, we've talked about fragility before, but this week feels different. This time, it's not one-off news, it's systematic signals stacking up.
Yeah, good morning, Richo. Mate, it's the world is in a state of flux at the moment. Wherever you look, there are issues. And I think it's starting to look like that where it used to be and where it's trying to get to is the two different areas. So, previously you had, very controlled systems. Everything was under control with the reserve banks and the markets and the currencies. No one was isolated. We were really pushing hard on globalization. There was, prices of credit prices were way down. Globalization was red hot and inflation was pretty low. So everyone was pumped and things were happening. So we've gone, and in that environment, we were also, everywhere you look, there were free trade zone agreements being signed and everybody was getting access to all markets. So now, though, we've sort of it's all coming to a bit of a head, because there's issues that have come out of all that, and now everyone's trying to deal with those issues. So you've now, like we've said previously, you've got two of the biggest economies in the world, China and US. China is the biggest manufacturer in the world and US is the biggest consumer in the world, and they're now headbutting. So there's really only two ways you can sort that out. You can either go back to China and get them to play by the rules, which is the Western way, democracy rules, or you can go the tariff way. And at the moment, Trump's going to push hard on tariffs. 54% tariffs on Chinese products is going to have a massive effect on anything, no matter how you slice it. You're going to put prices up by 55%. So, some people are going to see tariffs as a tax on families and companies and everybody, which pretty much they are. But at the same time, tariffs are a mechanism for maybe manufacturing to be clawed back in the American economy. Then mixed in with all that, you've got OPEC, increasing production. That's a part of the market that not everyone sort of pays attention to, but it has a massive effect. They either increase production or they slow down production. Central banks also are a little bit like OPEC. They're the mechanism that controls interest rates and the flow of money, just like OPEC, controls the price of oil and the flow of oil. And that's all mixed in. The reserve banks and the central banks globally, they can manipulate interest rates, and then the flow of money then takes over from there. Interest rates really are the price for money, and the price for money gets affected by the flow of cash. So, meanwhile, Australia sits there and watches and waits.
All right, Al. So let's start with the US-China saga. So just weeks ago, we had easing tensions and improving relations out of Geneva, tariffs lowered, tempers cooled, but that peace didn't last long. This week, China's accusing the US of violating the Geneva deal by blocking chip exports, denying student visas, and ramping up industrial tariffs again. Trump, never one to blink, responded by doubling tariffs on steel and aluminium imports to 50%. And this isn't just tit-for-tat politics. These moves are inflationary, full stop. They inject cost pressures straight into supply chains, which feeds into higher prices for consumers. And it's not just metals. Chinese consumer goods are now facing a 54% tariff. That's a tax on everyday essentials for millions of households. Al, doesn't this force the Fed into a corner? Rate hikes won't fix trade-driven inflation, but rate cuts risk looking soft on price stability, a true monetary catch-22?
Absolutely. I guess when you're going from a free trade zone environment where everyone is, embracing globalism and all markets are being open to, going the other way where you're closing markets and starting to put tariffs on things, then there's a big adjustment. Everyone's going to have to make a humongous adjustment to all that. And yes, I guess the reserve banks and OPEC and governments generally have only got a certain amount of tools which they've got to apply to fit into this new environment that we've got and get to the point where they want to get. And then it's not just single governments, as in the Americans; it's all governments. Everyone's got the limited amount of tools, and they've all got to adjust those tools as they see fit for their own economies. So that is going to put a lot of people in a rock and a hard place. Reserve banks want to stimulate their economy, but they don't want inflation. They don't want to, they want to slow their economy down, but they don't want to push it into a recession. Absolute. But that's not just now. That's been going on even in globalization areas. You go back to Keating days, that's exactly the same issue we had back then. So it's constantly a catch-22, and it's constantly an environment that they've got to monitor and stick to their rules. So, this then, as you said, it flows across to the entire economy. So if you start putting tariffs on things, that's going to push the prices up. That's then going to push interest rates up because it'll be inflationary. If you muck around with, currency levels and all that sort of stuff, that will definitely flow through to, credit. Because what happens is, people have this standard of living that they're used to. They've got their mortgages. They've got probably, available credit on their Visa cards and things like that. And then suddenly the prices pop up, but they don't want to lose their standard of living. So they continue to buy these goods that are in the market that are higher price. Suddenly, before they know it, they've maxed out on their credit. How they then dip into their equity on their house. They've maxed out on that. And so it squeezes everybody. And if interest rates go up, then suddenly you've got a recession before you know it. So, yeah, too much. And then that then brings the other, in this ether as well, this discussion is just interference by governments. Part of the problem here is that supply and demand is not dictating where the prices are. The governments are interfering so much that you've got no real idea of where the demand is or the supply is. So it's all a little bit artificial.
And this creates a problem for the Fed because their tools are typically demand-driven, but we're dealing with supply-side inflation here. So, what tools do the Fed have at their disposal?
To me, the Fed's only got two objectives. The reserve banks have only really got two objectives, and that's unemployment and inflation. The mistake that everyone makes is that the reserve banks are running the economy. They're not. They've just got to focus on their two objectives, and that's it. And yes, it could be supply side, but then supply side quickly becomes demand side because everyone then pushes for wage increases because the prices have gone up. So you can't just isolate one side and say that's the issue because it will flow onto the other side. And if everyone just sticks to their game, so, the governments are there spending money like there's no tomorrow where there is, they're just paying for people's gas bills and all that sort of stuff. And then they're saying, the Reserve Bank's got to manage the place. It's not the Reserve Bank's responsibility. And that's part of the problem. People just did what they should do. Governments should back off, stop spending so much money and let companies, take up the reins and then cut their spending or push their taxes up and get their budgets back in order.
All right, Al, so let's move on over to energy. So OPEC might actually be loosening the taps. A $411,000 barrel per day production lift in July could push crude oil to its lowest price since 2021, just as demand outlooks weaken under the weight of tariffs. which, by the way, is a huge pivot. Just months ago, they were defending $80 per barrel for oil. Now it's survival mode. If demand doesn't show up soon, energy markets could become a deflationary force. What are your thoughts, Al?
Oil is one of those areas that everyone in the financial markets, like reserve banks and fund managers and people, all focus on oil because they understand the importance of it. But people on the street don't pay too much attention to it. Oil definitely has a massive impact either way. It can be deflationary, but it also could stimulate demand. If oil prices are dropped, that could be an almost indirect way of dropping interest rates. Instead of dropping interest rates, if oil prices go down, they could actually do the same, create the same environment, same result where it keeps prices down whilst you've got tariffs on things, but oil prices dropping, so prices remain steady or go down, then it really pushes up the demand in the economy, and as demand increases, it could actually be inflationary and things like that. So it's sort of all linked in, but it's certainly an area that people don't pay too much attention to.
It's interesting, though, Al, what the Fed can't do, OPEC seems to be doing. So maybe this is another tool that's coming out in this crisis situation, which is adjusting the system accordingly.
Definitely. And that's again why it's so incredibly hard to understand where all this is going, because we're so interlinked and there's so many markets that are interlinked that it has flow-on effects that are very, very hard to read, you know. Prices go up when demand goes up. Prices go down when demand goes down. Above all this also is you've got these economies that rely on selling oil for their economies. So they're trying to manage their economies and the only product they've got to sell is oil. So that's another factor in a number of countries around the world where they're going to they're going to manipulate that price to stimulate their own economy. So it's all in there. It's very hard to read where it's all going.
Okay, so now let's look at these impacts locally. So Aussie bonds are steady. The GDP print held at 1.3% year on year, and home prices keep inching up thanks to back-to-back rate cuts. But under the hood, caution. Offshore borrowing remains elevated, and any risk-off wave could force the RBA's hand. We're calm now, but exposed. A downgrade or shock in global credit could ripple into Aussie margins and bank funding spreads. So, Al, your thoughts?
Prices are still going up. Central banks, as I said earlier on, only have two things to look at: inflationary and unemployment. Inflation goes up, they've got to adapt to it. The only tool they have is interest rates, really, when you think about it. They can manipulate the supply and demand, which then flows across to the interest rates. So as long as they stick to their guns and they monitor inflation and monitor unemployment, do their job, then all is good. But the reason why it looks like, reactive, well, for my money, reserve banks can only be reactive because they don't run the economy. The government's running the economy and all the other economies around the world. So they wait and look and watch, then react. And they maintain those two objectives. So the reason why at the moment it's really, really hard to see what the reserve banks are doing, and while the media in Australia, for example, is just bashing up the governor with regards to interest rates, is because you've got someone like Trump, who's the biggest economy in the world, that changes his mind daily. So if you're a reserve bank and you're trying to maintain inflation and you're trying to maintain unemployment, you've got to react to that. And that's just a nightmare. How do one day we've got 140% tariffs going on, and the next day it's only 54% tariffs. So that's going to have an effect. So the reserve banks have got to fit in there. They don't have a say in the economy. They're just got to react to what the government does, and then they've got to react to what other governments doing and other politicians are doing. And then you use interest rates, and interest rates, the world knows, if they haven't worked it out by now, interest rates are a blunt instrument, pretty much the only tool they've got. But it doesn't fix the problem. The problem is you've got to wheel in, government spending. You've got to rein that in. You've got to cut costs. You've got to put taxes up, all these other things that are too hard. Governments won't do it. So they use interest rates, which are a blunt instrument.
Okay, Al, so let's talk about US consumer confidence. That's another talking point for this week. It appears brittle. Credit card delinquencies just hit 11.35%, the highest since 2011. Emergency savings are being raided just to cover food and rent. And that's just before the tariff hikes hit retail prices. A 54% tariff on Chinese goods is coming. So anyone at shopping at Walmart or Target are going to get a shock. It's a classic stagflation trap. rising prices, weakening growth and rising unemployment. The Fed's inflation gauge doesn't even include the new tariffs yet. So, Al, does this mean buckle up?
Spot on. Anything is possible in this environment, and for me, it's going to get tough and it's going to get ugly. They've got massive problems everywhere that are not being fixed. Debt is just continuing to climb. Economies are sort of grinding to high. Everyone talks about rates going down because we're heading towards a recession. I mean, if we're heading towards a recession and every country in the world's got massive amounts of debt, how do we service that debt if we're heading towards a recession? It just means it's going to be bumpy and it's going to be tough. The government, if the government doesn't do what it has to do, which is cut spending and rein its budget in and do the right thing, then the market will force the government's hand and do it for them. If you use Australia as an example, we've got $400 billion borrowed from overseas. If we keep dropping rates, but the risk is going up and up and up because we've got way too much debt, then the offshore investors will say, we want our money back. They'll be selling, bonds in Australia, which will push yields up and selling Aussie dollars and going home. That's the way the market forces the government's hand. Then they'll have to adjust. They'll have to deal with their costs. So that's the environment we're in, and that's the same in America. That's the same everywhere. So you've got, you go from a free trade zone, which is what I've already said many times, to another system, or back to an old system, if you like, with protected environments and high tariffs and all that sort of stuff. There's going to be massive adjustments to be made. And I think we've only just started, really.
Yeah, it's interesting, when I look at the last 10 to 15 years, I'm starting to view that as the anomaly, and now we're reverting back to what we had in the 80s and 90s.
Yeah, I think it was a dream, and we embraced it, but now we've got issues, and now everyone's buried their head in the sand a little bit and haven't adjusted as we're going along. So we've now got extreme amounts of debt. If you look at Australia, we're just so reliant on residential property. That's the Shangri-La. We've pumped that so badly that prices have gone through the roof. Meanwhile, we're so reliant on offshore. We don't manufacture anything anymore, and governments just keep spending. So we're building a rod for our own back, and we're not really, we're not paying attention to the issues that need to be addressed. We're just kicking that can down the road, as we've done for the last 10 years.
All right, Al, so let's wrap up. Here's what stood out. Trade tensions are back with a vengeance between the US and China. The Geneva truce is fraying. OPEC plus loosening production equals lower oil prices ahead. Central banks are divided in their ability to control inflation, and rate cuts may come too late. Australian markets are steady, but skating on global thin ice. And US consumers are reaching breaking point with delinquencies rising and real wages falling.
Absolutely. All of those are correct. Couldn't agree more. Trade tensions, I don't think they ever disappeared. I think initially America embraced, I guess, China. China took the initiative and went for it, and it was the Western world's fault. They basically, chased the cheap labour in China. But the problem is that oil doesn't mix with water. It's a regime as opposed to a democracy, so they're going to butt heads. And I think that tension's been there from day one. I think we turned a blind eye, or companies turned a blind eye, because they were chasing the profits and the attraction of cheap labour. But in reality, the government differences has been that tension. Now it's coming to a head because we've got massive issues everywhere. And it's not just the Western world. China's also got massive issues. So you've got the two biggest economies in the world butting heads. So you don't know where that's going to go. Then oil prices, they're in there as well. That's in the same mix. So for me, definitely in the next 10 years, the world's going to be in a different place, big time. It's changing right now as we speak. So hang on to your hat, I think.
Well, as always, many thanks, Al, for your valuable insights this week. That's a wrap for this week's edition of the Weekly Edge. Keep your eyes open, your allocations nimble, and as always, watch the edges.
Absolutely. Thanks, Richo.
Thanks, Al.
Thanks for tuning in to the Weekly Edge. At Gilt Investments, we're here to help you navigate the fixed income markets with clarity and confidence. As an Australian fixed income brokerage licensed to advise and deal in fixed income securities, our experienced team is ready to help you reach your investment objectives. We hope you enjoyed this week's Edge and that it helped keep you in the loop and ahead of the curve. Until next time, stay sharp, stay focused, and we'll see you on the next episode of the Weekly Edge.